Got a question about implied volatility, specifically around SOFI, which we all felt. Okay, so here's a question by Priest 1050. Priest, thank you for your question. I'm more than happy to answer it. Good afternoon, Real. Would it be possible to do a video on implied volatility on the SOFI options? I have the $8.50 strike with 816 expiration and 50 strike with the 823 expiration, where I bought them should be printing money, but that just seems to not be the case. Who, what, where, how, those types of things, if you have the time, kind sir. Well, I do have the answers. We've talked about it before, but let's break it down based on your specific situation, in which I also am in. All right, let's get into it. What's up, everybody? It's Stocks for Real. My favorite color is red and black, but it just turned out to be a red day, right? So I'm making this video because I was going to address a question by Priest on YouTube, okay? So, hey, Priest, I talked about this a little bit in a couple of my videos, and hopefully you caught them, but essentially implied volatility is the amount of interest that people have in an options position, right? Traditionally, you see that number inflate or increase prior to earnings. Why? Because there's a lot of factual information that's not yet known. So people are interested because of the anticipation or the assumption of what the report is going to be for numbers, right? So it's just like, I guess a good example is, let's say NVIDIA, just whatever, NVIDIA has been doing numbers, right? So everybody knows that we've been in this AI craze. And essentially, we also know that NVIDIA has been leading the charge. However, they've been on an amazing bull run. And you assume that like something has to break, right? Like something, they can't keep climbing from here. So you might have a high level of interest from bears. And then you also have those people that think that NVIDIA had more room to run. So they'll bet with the stock. So they'll go into the calls. So put in some calls. Those, in that situation, you would see the implied volatility increase probably from like an 80% up to about a 200%. Okay. The higher that number, that implied volatility, more likely the higher the premium. So it's like a supply and demand, right? If you have a limited amount of something, or you have an increased interest in something, like something's in high demand and people are just going to buy it regardless, well, then they're just going to raise the prices, right? So that's kind of what's happening here. Okay. So, but to look at your contract specifically, just so you know, I'm in the same contract. One, I got in off the pullback that I had put on the SOFI video that was likely to happen. And then I ran that up, I want to say 76 to 80%. And that was the target, the first target that I put out in that last SOFI video. So it sounds like you didn't make profit, man, and I'm sorry, but you gave yourself time, which is the most important thing that I was stressing, because SOFI doesn't just pop when you want it to pop. It's a very manipulated stock. And at this point, everybody's anticipating that SOFI is going to crush numbers and then it's just going to rocket right out the gate. That's what it's done time and time again. But now we're in a position where SOFI is gaining more interest from the retail investors, okay? Despite the overall bearish sentiment, okay? So market makers and institutions, you know, they are trying to suppress the stock, right? And trying to play the waiting game to keep people out and just prevent it from just going off, because they'd have to pay a lot of people, right? A lot of money, okay? So just to look into your position. So we're looking at the, okay, you said the 850, right? So the 850 call. Now, one thing that I can't say, like, I don't know exactly what the IV was prior, but I can't speak to the $8 IV. And for the $8 8/16 expiration, that IV before going into earnings was about 92%. Okay, after earnings, it was either 88 or 92, one of the two. That was the range. And after earnings, it dropped to 66%. Right. So pretty much what that means is that everybody lost interest. A lot of people lost interest in the options. So when people are losing interest in something and you still have like a small demand, what do? You lower the price, right? So the premiums dropped, which means that um, your gains that you suspected also dropped. Okay. It's very unfortunate, but that's just the way the game goes. You typically don't see drops that aggressively, especially when you have a stock like SoFi that absolutely crushed their numbers. Okay. Like, so they triple beat and then they increase their forward guidance. And then they introduced new products, right? So you would assume that the interest or the implied volatility would either increase or maintain some level of stability between the 90 and 110% range. But that's the manipulation of the stock, in my opinion, because if this was any other company, that implied volatility wouldn't have dropped that aggressively. Okay. So looking at this, what you want to do is go into the options. I don't know if you know much about Webull, but that's what I'm going to use to kind of demonstrate this, right? So because your option is already kind of like beat, right? Well, you know what? Let's do it. So we open up the options contract. We're going to click this button that says single options. Okay. This brings up the menu that you see here. Now you see the delta of 13.13. You see the implied volatility of 73%. Now that's increased because I'm going to assume that an 850 call what implied volatility or interest was greatly reduced more than the $8 call. So it seems like they're progressively increasing interest in the stock. Okay, and to go from 66 to 73 is probably because they actually introduced the credit cards that they were speaking to on the earnings call. So anyway, we're going to click into where it says buy SoFi at 850, 8.5, and then this brings up your chart, right? It brings up the contract. You see the open interest is still 85,000, huge, and then there's a volume of 1,700. So that's massive, right? And that's why I targeted 8/16, and but you can only cross your fingers. But there's a lot of open interest for that date. Now, I don't want to get into it, but anyway. So we're going to click on what is called the calculator. Okay, calculator. Now, here's what you see. Right now is the first. Let's say we're going into tomorrow. Okay, so I want to show you tomorrow. And right now, the stock was trading at close at $7.16, which had a premium of 106. I'm sorry, 0.06. Let me just make sure that match. So between yesterday, today, August 1st to August 2nd, you're not seeing much of a difference in the premium if the price were to stay the same. Okay, so not much of a drop off. But what I want you to pay attention to is where it says implied volatility, and this is something that you can do before you hop into a play, especially if you're playing earnings hot. You need to understand what would happen if this happened, and you know what I mean. So like the good and the bad. So if I click into implied volatility, we're at 73.09%. Okay, well, what happens if interest goes up to, let's say, 86? Look at the theoretical price, right? Which I might have to go back, but it's at $11. So let's go back and make sure we paid attention to what that actually was. Okay. Calculator. And tomorrow, right now, the contract, the ask is $7. Tomorrow, the ask will be $7. Okay, so the implied volatility right now for tomorrow, 73. But if that increases, let's say to 86, you went from $7 on the premium to $11. Okay, and that's with no price action, right? So the price stayed the same, but the implied volatility increased. Now let's bump it up again. So SoFi was talking about introducing subscription services. And right now we know tomorrow, 8/2, is Friday, and a lot of contracts, $8 contracts and $7.50 call options or puts as well, those will fall out of the money. So there's going to be a lot of people not happy because the market makers pretty much put you within this this funnel, a dead zone essentially for SoFi where nobody can make money. Okay, but let's say that the interest increase. Let's say it's what I am used to seeing is about 96%. Now look at it. Your $7 or your $6 went up to $15. So you're 100%. And that's again with no change in the price. Okay. So that's at $7.16. So what we're looking for is for pretty much everybody that has contracts for tomorrow, dead it out. It sucks. I'm sorry if that's anybody that's watching this video. Just know with SoFi, you got to get yourself some time. Otherwise, you'll get smoked every time. They won't pay people, right? So let's fast forward. Let's take a look at the 5th. All right. So on the 5th, if we maintain the implied volatility that was there, right? And the price doesn't change. So Monday, the stock or the premium of this would be $5. So you'll lose another $1 on your contract if the price doesn't do anything. Okay. So everybody got cooked. Tomorrow, everybody's getting cooked, right? We're on to next week, August 5th. Let's say at that point, market makers, institutions, retail investors, everybody's just like, what are we doing? SoFi is a great company, or SoFi, I want a piece of this company. Well, let's say everybody starts loading up, right? So my prediction based on those estimates from the report, based on the report and then the forward guidance, is that SoFi was going to at least hit $10. Now, will we do it? I don't know, but let's just see what we got. Okay, at $10 with no increase in implied volatility, you're looking at a theoretical price of $158. So you would have taken that $7 to the $158, right? So I understand that you probably bought this. I don't know. You probably bought it for $13. Let's just say that's what you bought it for. Now it got slashed in half like everybody else's contracts. Well, this is why we give ourselves time, right? Two things. The problem with playing earnings is that you can't really cut your losses. Like if you get smoked before the opening bell, right? Like there's nothing you can really do. So when the market opens, you have that choice to take that 50% L, or you hold on and give it some time to breathe, and then see if you come up. Now, if you play light and you didn't play too aggressively, then that might be easier to do, right? Let's say $25, right? So you put $25 on the SoFi call option playing earnings, and it's not going your way, right? You lost half of that, $12.50, right? $12.50. So you got $12.50, and that's half your money gone. But you're like, it's just $25, so I'm just gonna hold on for a little bit, right? And then see what happens. I got 2 weeks. It's easier to do that when you're not like aggressively in. It's harder if you had a couple stacks in it, right? And now you're sitting here with, let's say you had $1,000 and that got cut into $500. Now you have to ask yourself, man, are you okay with taking that $500 L and then just, taking your licks and moving on? Well, that's a decision for you to make, because ultimately what you have to ask yourself is that if you hold on and you see that 500, that 1,000 go to 500, and then that 500 go to 250, will you be sitting there saying, man, I should have took the $500, right? That's something that you really need to think about before you get into these places, especially SoFi. Okay. So now let's be a little bit more conservative here. Okay. So let's just say next week we hit $8.50. Okay. I forgot what my targets were from the last video, but let's just say 850 is one of them. Okay. Now 850, and with no change to the implied volatility, we're looking at a theoretical price of $47. So again, you would have had $13. You lost. That went down and got reduced to $6, right? And then you held on till Monday of next week, and the stock ran up to 850, and here you are with $47. You're happy, right? So, but typically when the price starts to rally like that, your implied volatility also tends to go up because there's going to be more interest and people want to catch that rocket, that move, right? So let's say that on a conservative side, SOFI goes back up to about 86%. Well, that $46 turned to $52, right? What I'm used to seeing is anywhere between 96 and about 112% when SOFI is kind of like on the move, right? So with 96% as an example, we're looking at $59 per contract on this particular call, right? So I want to keep this short. I don't want to extend it more than this. This is just to answer the question. Hopefully this helps. I do want to address the SOFI holders, and I want you to know that I am not a SOFI pumper. Okay. I'm a guy that's heavily invested in SOFI. I believe in the company. I understand the fundamentals, and I'm in it for the long haul. If you are going to be scared, and if you are going to scold or like talk down to people that are talking about SOFI and blaming them for your bag being lost, then SOFI is not the company for you. High risk companies are not the companies for you, right? You need to do your own research, and you need to be responsible for your portfolio. I will tell you that I'm still in SOFI. I still have my calls, but I predefined my risk before I got into the play. I called this to happen before I got into the play. Now, why did I get into it if I called this out? Well, that's because there's always that off chance that it doesn't pull back and it goes on a rocket. Me listening to the earnings call, SOFI crushed it, and I thought we're just done. I thought sky's the limit, headed to $10, and then we're going to break through that hedge $13.38. I was not expecting. I was expecting the call to be great, but at the same time, they exceeded my expectations by a little bit based on what I gave out. So, but it didn't happen the way that I wanted it to happen. But at the same time, on the flip side, I was also mentally prepared for the downside and what happens like all the time when we're getting close to the end of a week, right? So you just have to understand your risk management before you hop into these plays that I might talk about, right? Because it's high risk, but it's high reward. So good luck to all y'all. I've been really busy. I'm trying to get this set up, but the next video that I'm going to be shooting is likely going to be Disney. Okay. Disney earnings is coming up. There's been a lot of negative news, but there's also a lot of positive news that I want to get into. Same with AMC, but I don't have time to talk about AMC. The only thing I'm going to say is that the box office has been killing it, and I'm banking on them with the lower debt, the decrease in debt, and then increase in concessions, as well as box office doing numbers. Records are breaking. I'm banking on that for the stock to rocket. And then the fact that we've sustained above $5 for a minute now. It went to sleep above a previous resistance. It's holding support. So I expect it to go up. All right. But that's just me. High risk, high reward. You do you. This is Stocks for Real. Take care.